Happy Friday, Brian Manning here with your weekly update. Let's get right to it. So, Monday this week started the week with stocks in positive territory. Had some money moving from bonds into stocks, and certainly hasn't been a huge help for interest rates. Interest rates have been relatively flat for a little while now, especially in the beginning of the week. And Monday we also got information on existing home sales on a national level. Did slightly miss expectations, but you know what? Year-over-year appreciation on a national level is at around 4.7%, and we call that a Goldilocks report. You know, not too hot, not too cold, just kind of chugging along in a really good sustainable area. And great to see. And you know, even though we may have missed expectations on the home sales, keep in mind we just came out of June, and June is typically the apex of the market. June, July, August. So when you're looking at home sales being down just a little bit for the month of August, certainly not the end of the world considering what we just came out of and the prior months that it's being compared to. Also, first-time home buyers increased from 30% of all home buyers to 32%. Really great to see. National Association of Realtors will tell you that historically, first-time home buyers make up a larger percentage of the purchasing pool. And really great to see this. And if you've taken any of our classes, especially the social media one as of lately, we're talking a lot about millennials and how they're taking over baby boomers and are certainly becoming the largest pool of first-time home buyers. So be ready, because you're going to see some big changes in our markets coming up, certainly in a positive area. Tuesday, stocks were down sharply, still based on concerns in China. Definitely affected our market there. Also got some feedback from the Mortgage Bankers Association, and this week compared to last week, purchase loan applications were up 9%. So seeing a little bit of rebound there in purchase transactions. Thursday this week, stocks are being sold off, a lot of money moving into bonds, and a lot of this really just based off having a really strong dollar right now, and the stronger dollar is certainly affecting corporate earnings. So seeing a little bit of movement of money there as well. And then the big thing was Janet Yellen's speech yesterday, 5 p.m. Eastern time. And you know, throughout the speech, Janet Yellen did make a comment, said that she personally is in favor of a rate hike. And I think this is the first time she's probably come out publicly as of recently and just made some verbal comments of what she's personally in favor for. And you know, when the Fed chair suggests that she's in favor of a rate hike, certainly could take some other voters that were maybe on the fence before and push them into being in favor of a rate hike as well. So we'll have to wait and see what happens. So 2 more Federal Reserve meetings this year for opportunities for rate hikes. First one would be in October, but the Federal Reserve meeting in October does not have a press conference associated with it, so probably unlikely that you'll see a rate hike in October. There will be another conference, another Fed meeting in December, and that one will be followed by a conference. So I have to wait and see what happens. And today we got our last second quarter look at GDP. So GDP basically represents the dollar value of goods and services produced over a specific period of time. So you can kind of think of it as the size of the economy and whether the economy is growing or not growing or shrinking or whatever it may be. So original reports for second quarter GDP was that it had increased by 2.3%, which is okay. Then they revised second quarter GDP to increasing by 3.7%. And we got the final revision today, shows second quarter GDP of increasing at 3.9%. So good to see the U.S. economy is chugging along and seeing some increases there as well. Talking about mortgage rates. So we haven't seen mortgage-backed securities been in a position to break above what's called the 200-day moving average. So mortgage rates go directly opposite based on what the cost of this mortgage-backed security is. And it's been a tough fight for this mortgage-backed security to break above the 200-day moving average, which also means and translates to mortgage rates have not been able to edge lower based on what's happening in the bond market. So this could really go one of two ways. Right now, it looks like that we're kind of losing the battle on mortgage-backed securities. If money continues to flow into the stock markets, that will have more of a negative effect on bonds, and you'll see mortgage rates slightly edge higher. If for some reason we're able to muster some strength and break above this 200-day moving average, it would be positive for mortgage rates. So we'll have to wait and see what happens, but unfortunately not hopeful of being able to break through this 200-day moving average. We've been testing it over and over and over since August 2nd, and only one day we've been able to break above it, and then we've retreated. So mortgage rates have just not reaped the benefits and been able to edge lower. I will be around all weekend. Certainly would love to be part of your business. If you have any buyers need to get pre-approved, give me a call. We'd love to help you any way we can. Have a great day. Happy Friday.